Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 6th day of June 2014, and this is the daily report for gold and silver, our weekend review. Well, we do have gold ending up slightly higher on the week, in essence unchanged on the day. Currently trading roughly 1252, 1253. The high on the day has been 1259.10, the low 1245.10. Silver also trading in essence unchanged to a couple of cents lower. Current print on the screen that you can see is we're at 1900 even, the high 1931 and the low 1881 on the day. More on silver towards the end of the show. I want to start today's show by looking at a daily chart, Japanese average format, and it's quite clear when we look at this chart that just following this band of congestion that we had, and this is really the characteristics that we had pretty much throughout May, as you can see right here, this is the entire month of May, broke to the downside beginning of June. And really the reason for looking at a Japanese average chart when you get a scenario like that or a scenario like this, in other words, the market has corrected to try to indicate some sort of a pivot point in the market, a key reversal area, we look for a couple of things. We look for the strength of the trend or weakness of the trend, and that is really the strong suit in a Japanese average chart, because it's average based, because these candles compare themselves to the midpoint of the prior day on a daily chart. You get a scenario in which you can see when that current downside trend is weakening. You can also see when the current upside trend is weakening, but it shows you strength or weakness in a trend. The way that we do that is quite simple. On a market which is moving lower, first we look for an absence of these lower wicks, because what the absence of an upper wick, because what the absence of these upper wicks are telling us is that there was no point during the trading day in which we saw the price activity trade above the midpoint of the prior day. And that's simply an indication that the price point is consistently moving lower, and it's moving lower in a way that it doesn't even hit the midpoint of any of the preceding candles. The other things that we look for in terms of the Japanese average charts is the actual size of the candle. So a larger candle represents a stronger trend because of the distance it's closing away from the midpoint. Now, as that trend begins to weaken, we begin to see signs in the following categories. First thing is that we start to see a reduction or smaller body size. Body size should start to get smaller. Now, it's not always the case, but it does occur with decent frequency. If you look at the size of these candles right as this market sells off here, you can see they're pretty large, and we're comparing them relative to the candles that are around them. Then we look for what we call a pivotal candle, or that doji candle. And the doji is simply a candle in which the open and close are the same or very, very close. You will sometimes get a pivotal candle that already converts to green. Many times, though, you will get a red candle, and then the following candle is going to be a green candle, and then you'll start seeing our upticks. Now, let's take that representation and look at our current trading activity. Well, as this marketplace came down, no doubt we had very, very large candles in terms of body size, especially when you compare them to what we had been experiencing, which was that narrow range. As this market began to approach the 76% retracement area, and the retracement, of course, is from the rally of 2014, $200 rally in which we saw the market go from 1180 to just below 1400, 1391. So as it comes down, you can see just a few days ago, and this is when we really started looking, was when we saw this candle right in here begin to get real small. And so it's doji-like. It doesn't have any real tails, but there's no doubt it got real small. Following day, this is yesterday's actually the big rise, and that's why you'll see a big difference between a Japanese candlestick chart and Japanese average chart, because you'll see that this big move of yesterday isn't reflected. But when we have a nominal day today, which in essence is unchanged, because of the relationship to the midpoint, we get this nice pivot point. And I've gone back and converted this chart into a standard candlestick chart. Now realize, the only real difference is how these bodies are drawn. These are true representations of, on a daily chart, where the market opened and where the market closed during that trading session. So what we see then is a marketplace in which we have some similarities. And what I mean by similarities is the doji is going to be present in both. So you see these doji-like candles at the bottom. We had this nice move up. We really didn't get the follow through. We closed in essence unchanged, as you can see, by virtue that you have a doji, and at the same time you have the doji, you have it right at the place in which we saw this market close yesterday. Now, on the whole, in terms of the week, we closed up very, very slightly, and you can see that in this weekly chart. All I've done is converted our daily now into a weekly, and this last candle right here represents this week in trading. And so when we look at it through the weekly, of course, we're compressing time, and when we do that, you can see really the consolidating marketplace right before the break, because you get alternating candle colors, the long sell-off, which took approximately a week, and the recovery that happened this week, if in fact the market does begin to trend higher, which I believe that it will. Now, reason for our stop on this particular trade. Well, my sense is that the line in the sand, so to speak, has got to be the 76% retracement, roughly at around 1233. There's another price point, a 50% retracement that comes in, I believe, at 1229, 1230. And that's a very, very long-term retracement. So there is a harmonics there. So that makes me feel fairly comfortable with this as our protective stop loss right in this area at about 1232. Now, on a technical basis, I wanted to spend a couple of minutes and tell you why I called that a line in the sand. We're looking at the same weekly chart. I've simply compressed it so we can look at some more time. We have this double bottom, 1281. If we draw a line, this is simply a horizontal line that's extended all the way back. When we do that, we find that there's a significant level of resistance at this price point. It tops above it and then finds support right here, because you can see it goes above it. As it comes down, it really finds support. You almost have a three-river morning star at that point. That's a pretty significant point, considering the fact that we've had these two dramatic bottoms as the market sold off from 1800. If in fact the market could not hold, or cannot hold, I should say, this 76% retracement at 1233, I'm going to try that, line that up as best I can. I really feel that we're in almost, on a technical basis that is, nowhere land between these two price points, meaning 1191 and 1232. And so that's why I feel that this is such a critical level right now, because if this level's breached, as I've said all week, we'll probably make a play for these lows. Right now, at least it appears as though we found some support, and these lows will remain the lows in the marketplace. Now, I've gone ahead and pulled up another weekly chart. This is a chart that we've been using throughout this year and last year to represent important Fibonacci retracement points. And as you know, all we're doing is we're creating multiple Fib retracements that all terminate at the record top of 1900, and it's the starting point that varies. And of course, that starting point will determine the price point that it carries from. And then you can see where they extend out. This, of course, represents this longest retracement. So when we look at these different levels, if we take a look at the second retracement, and this starts from what, 546 all the way up to the top. These are a series of numbers here. A 50% retracement takes you to roughly 1229. And because of that, it does come in a longer term Fib retracement. I feel that when it lines up with the 32, we should have some level of support in that area. So what about silver? It's probably fair to ask, because I've been extremely bearish on silver for the better part of this year. Why am I now looking at this as a potential buy, and why did we trigger the buy signal the other day? Simply put, it's a matter of where these lows are falling in terms of where we've seen support in the past. All I've done is created a horizontal line from that low at 19 and then carried it over. And when we look at it, we can see specific target points in which the market found pretty strong support and then popped back up here at about the middle of 2013 here, right at the end or conclusion of 2014, beginning of or 2013, beginning of 2014. When we carry it back in terms of historical perspective, we can see that not only was this area a major resistance point, as the market had been fighting, moving back from what, $8, and this of course is back in 2008, 2009, As that market moved up, you can see these series of tops right in here. That was major resistance, and more importantly, when it broke above that point significantly, that's when we saw the market go parabolic. So my sense is that by looking at this as a target area right now, meaning 19, which is where we're in at, my sense is that we've seen such good support that we should be able to hold this level. This has been Gary Wagner, wishing you as always good trading, and we'll talk to you on Monday for another daily update and review. Bye-bye.